Welcome to Module 1, Lesson 3 of the ForexDelight Trading Mastery course. Today, we'll explore how the Forex market works. The Forex market is decentralized, unlike stocks. It has no central exchange. Trades occur electronically over the counter through a network of banks. This global network allows for 24-hour operation during weekdays, with retail traders connecting via brokers. The market has a hierarchy of participants. Tier 1 is the interbank market, where major banks trade with the largest volumes. Tier 4 consists of retail traders, like you and me, who trade through retail brokers in Tier 3. Forex operates 24 hours a day through 4 major trading sessions: Sydney, Tokyo, London, and New York. London has the highest liquidity, and New York overlaps with London. The overlap between the London and New York sessions, from 8 a.m. to 12 p.m. Eastern Standard Time, is generally the best time to trade. This period offers the highest volume, tightest spreads, and most volatility, along with major news releases. Understanding how your order is executed is crucial. You place an order with a broker, who routes it to a liquidity provider. The order is matched in the interbank market, executed at the best price, and then the position appears in your account. Every currency pair has a bid and an ask price, creating the bid/ask spread. This spread is your trading cost. The bid is the price the broker buys from you, and the ask is the price the broker sells to you. The Forex market opens Sunday at 5 p.m. Eastern Standard Time, when the Sydney session starts, and closes Friday at 5 p.m. Eastern Standard Time with the end of the New York session. Markets are closed on weekends, which can sometimes lead to price gaps on Monday openings. In summary, Forex is decentralized and operates 24/5. The best trading time is the London and New York overlap. Remember that the spread is your cost, and orders are executed through your broker to a liquidity provider. Next, we will cover Lesson 4, Understanding Leverage and Margin.